Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's November the 5th, 2015. So I thought it would be a good time to just give a brief update in terms of the last month. Now, when I did the last update at the beginning of October, we'd just been through a couple of really volatile and very difficult markets in terms of market indexes being down quite a bit. But since that time, we've seen in October a fairly strong rebound in many of the markets around the world, certainly in the US, not in Canada as much. In Canada, we have not had anywhere near the progression in terms of our indexes. But overall, around the world, a little bit of an uptick here in October and also into November. And we've been plodding along pretty good this year, certainly far better than the indexes, and in particular when you look at the Canadian marketplace, which has really been weighed down by energy investments, the energy sector, oil and gas, and also a couple of former high-flying stocks like Valiant Pharmaceuticals, which really has tumbled in the last couple of months, and we haven't had any exposure to that in that spot, so that's great. So we've been plodding along over the last month. The month of October, we rebounded probably a little over 3% in that month alone across all of our client portfolios, and that's with about 60% invested in the markets and the rest in fixed income. Over the last 3 months, we're up about 1.5% year to date, about 5%. That would take us from January through to the end of October. And over the last 2 years, we've been rolling along at about 8% per year. So not too bad considering the conservative weightings that we have in the portfolios and the kind of companies that we continue to own. And so even though the markets have bounced back a little bit, I want to just point out that it's very important to be cautious and careful in light of what's going on in the marketplace. The real game here is, what is the Fed going to do? The Federal Reserve, that's the US Central Bank. Everybody's focused on that. Are they going to increase interest rates anytime soon, or are they going to continue to kick the can? Back in September, everyone felt that they were going to increase interest rates fairly soon. Then they said no, they weren't going to. Then they came to their October meeting, and then they said, well, maybe we will. No one knows. Our view is it's going to be very, very, very difficult for the Federal Reserve to increase interest rates any more than just a very tiny bit. And if they do increase interest rates, they'll be backing off pretty soon next year, because the overall global economy is in terrible shape. And all of the other major central banks in the world are either holding interest rates or dropping the rates. And so for the US and for the Americans to think that they can increase interest rates and have their dollar go up even more and still continue to compete internationally, in our view, is a bit of a dream world. So this is what we talked a little bit about in our third quarter report at the end of September, which we sent out in early October. We talked about central banks doing the limbo. In other words, central banks dropping rates again and again and again. How low can they go? Which is the question that we asked. And so it's very fascinating because debt continues to grow, the deflationary pressures continue to mount, and so central banks are under a lot of pressure to try to get rates up, try to get inflation. How are we going to get inflation? We got to continue printing money, and it's really quite an interesting environment that we're in. But it all points to being cautious, careful, conservative, buying quality assets. Let me give you a couple of facts, if you will, that I think will just underscore why we want to be very careful and not caught up either on overly negative or get caught up too much with the bravado of the marketplace, and try to find a good middle ground where we can protect wealth. As of November 1st, half of the European government bonds that had less than 2 years maturity, so they're short-term bonds, half of them were trading at negative yields. And that's a little over 2.6 trillion euros were trading at negative yields. That means when you buy the bond, you're going to get less back when it matures. Negative yield, believe it or not. Here's a couple of other facts that are interesting that I think that you'll find, again, helpful in terms of saying this is not a normal market. Since September 2008, remember that was the financial crisis real hit there when Lehman Brothers went down, there's been 606 global interest rate reductions. Since that same time, there's been 12.5 trillion US dollars printed around the world by central banks. So you've had this massive inflow of currency into the marketplace. Since 2007, 2008, the Federal Reserve in the United States has been operating at zero interest rates, the first time in history that they've gone at zero interest rates for this long. And again, this is supposed to be a recovery. This is not supposed to be happening. $6.3 trillion of global bonds currently, so not just Europe, but also when you look at other places around the world, $6.3 trillion US is trading at negative yields. And there's 20 trillion in global bonds that are currently yielding less than 1%. And so you have all around the world, interest rates at rock bottom prices. People are worried. People are concerned. The credit markets are very, very nervous. And so we point these facts out because what it tells us and what it should tell you as our investors is it's important to be careful. It's important to buy quality assets. It's important to buy good businesses with very strong balance sheets. And that's, again, what we continue to do. So the bottom line for us in this environment where everybody's just talking about what the Fed's going to do and going from one number to the next, look, let's look out a year or two. It's going to be tough slugging. There's not a lot of global growth. There's a lot of headwinds. And therefore, don't get caught up with the day-to-day sort of headlines that tend to bounce the markets all over the place. Let's stay focused on really good quality assets, and that's what we continue to do in the portfolios so that we don't get overly optimistic or overly pessimistic, but buy companies that can protect us. So that's what we continue to do. We did note in our last write-up that we added another employee to the company, Andrew Chang. We're very glad to have Andrew as part of our team. And Andrew's working both in administration and also in research. And so it adds to our overall heft and strength in terms of our ongoing research and finding great companies and businesses for our investors. So if you have any questions, please call, email, or stop by the office, and we'll be sending out another update a little later in the month, and just to let you know what's happening in terms of the portfolios. Thank you very much for your support, and have a great rest of the day. Bye now.